Good afternoon, everyone, and welcome to the AOP monthly outlook call for the month of May. A usual format, try to keep it within 60 minutes. A webinar. We'll have two speakers today. We'll have Gary Duggan, the CEO of the Global CIO Office based in Dubai. And then we have a guest today, Francis Bossellini from Alaris Consulting, a firm that predominantly works for performance improvement with private equity funds across Asia, focusing on transactions and supply chain, and a lot of interesting insights from Francis today, particularly around the impact of tariffs. It's a webinar. We'll ask that Gary will present first, then Francis will present. Anybody with any questions, please put them in the Q&A box, and it will allow 15 minutes at the end for the questions. Gary, welcome. Last month was Independence. I don't know, are we still independent, or what do the markets tell us? And what do you think is going to happen going forward? Over to you.
Thank you, David. And yeah, well, it's an update on macro markets, but of course the main topic is the tariff situation, which has evolved a bit since we last spoke. So let me just walk you through what's happening there, and also just clearly what's happening in the background. But what I'm going to try and do is, in fact, if I go to my first slide, let me just see if I can. Yeah, not my first slide, which is to try to put this into a context. This is not just a one-off. And I think sometimes we just get tied up into the minutiae of what's going on in tariffs and kind of miss the big picture. I was just reminding myself that the US has been the biggest economy since 1890. And clearly they're sweating a bit at the moment because of the growth of the Chinese economy. And you can see this now in terms of the way in which the Americas bristles with whatever China's doing. And the tariffs are probably just a manifestation of that bristling and wishing to push back. The second problem we've got in the world, which again is not addressed by tariffs, but the general conversation about what's happening in markets, is that we have some very highly indebted economies. The US is one example of that, but clearly across the world. And countries are trying to deal with the politics around that and trying to find the policies to still look big and still be able to grow, but with a huge burden of debt. But graying populations, declining populations, and many other things are really bringing about a declining growth. So just think of it as the heavyweight who was at his prime in his 20s. He kind of gets to his mid 30s and is struggling to find that little bit of energy. And I think that's a little bit where some of the major economies find themselves. And then they kind of just say fight dirty, which I think is what the tariffs is all about. So anyway, that's just to set some context. But let me just go forward and just say, what I'm trying to do is to find the balance of the good news and the bad news, because it seems at times we only focus on the bad news. But to be fair, in the tariff situation, there has been some moderation of that bad news, although we've still got a challenge. So this is something I've stolen from JP Morgan, and I think it summarizes the last few weeks quite well. So we started out on the black line at the bottom, which is the level of tariffs, the effective tariff rate for the United States, which is around about 3% in round numbers. And then after our wonderful Liberation Day, we went up to the 25-27%. But then, of course, as we saw, the Trump administration felt the heat a little bit, and we saw some exclusions and adjustments. And then there's been discussions, well, it doesn't have to come from China. We can find another way of getting that Chinese product. So let's just call that the substitution effect. So at the moment, we're round about an effective tariff rate, let's just say of 15 or 16%, but that's still multiples of where we were before this whole conversation started. So that's what people is still weighing on the global economy. It's still weighing on people's forecasts for the future. The good news is that there's less bad news in the markets. I've been using this graphic with a number of clients over recent weeks just to show the degree to which markets have corrected. Now, they've corrected off their highs, but if you have a look back window of 5 days, 1 month, year to date, and 12 months, there's far less red on the screen here. At one point, everything was virtually red. Because the markets year to date were very often down or close to zero. So there has been some stability, But that stability clearly is about where the market thinks we're going rather than where we necessarily are going. So to set the context, the problem that people have at the moment is that they're hearing this bad story, but they can't put a value on it. So to give you one example of that, or one picture of that, this is two lines, one for inflation, which is the dotted line, and one for growth. And this shows the degree to which economic data, so the hard data, is telling us about the current trends. And the last data points are close to zero. So we have the information flow from the hard data is that there's no problem, but we know there's a problem. And so I thought back to the last few years, and I've been working with AOP for some years ago when we had the COVID crisis hit. And so let me explain why this is important in terms of the way I think about the next few weeks. The blue line here is the progress of the S&P 500 from the day that we heard from China that there was a significant challenge of COVID. And we went through the subsequent months with the market going up. Now, when we think about it now, of course, with the benefit of hindsight, we go, why was the market going up? Well, the market was going up because it didn't have the hard data that COVID was impacting the economy. Now, I'm careful in my choice of words because actually I sat in a forum in Abu Dhabi in early February where the CDC guy, with an audience of only 30 people who bothered to turn up out of 2,000 delegates, said that COVID was going to impact every individual. Indeed, we'd all have to get COVID before this would be over. So even with that kind of dialogue going in, the market was still going up until the hard data came in. So our market on this cycle, which is shown with the orange line, has gone down. It's gone back up again. Markets are hardly moved, quite frankly, since the beginning of the day, the beginning of the year. And yet, I still say we have some damaging times ahead. When that hard data comes in, I think we're going to see markets tip down. So even if markets have not done very much so far, that doesn't mean it isn't going to happen. COVID was clearly, I hope, a very exaggerated form of what we're going to see. But just because the markets haven't gone down already, it doesn't mean they won't do in the future. So what is it we're worried about at the moment? Well, we're only really seeing little dots of trouble because the data, whether it's US industrial production growth or retail sales in the US or in Europe, we're not going to get those data points reflecting what we're now facing in terms of the tariff challenge for some months down the road. But the scale of what we're seeing in terms of the decline in global trade flows are enormous. So, for example, the biggest blob on there at 60% decline is ocean bookings from China to the US. So US West Coast port volumes have declined by 35% already. US import cargo decreased by 20%. And down there at the bottom, although there's been lots of politics around this one as well, but Panama Canal volume declines of 50%. So you can see trouble on this page. I perhaps should have used a kind of a red color rather than blue. This is what's going to have to come through the real data going forward, but that will take some time to come. So it's like people are not even focused on this page at the moment. They're just saying, well, we've stabilized and we look okay, so the future must be all right. Let me just say that, again, to go back to a positive, there's two aspects of the declining growth that we're now facing and a spike in prices because of tariffs. There's one of inflation and one of growth. Now, growth, as I said, will certainly be slower, whether it's a recession or not. At the moment, the market priced it at around about 40%. The good news is there is an offset to the tariff increase in terms of the general level of prices across the world. So this is a chart with a dotted line showing the year-on-year changes in oil price, and the blue line is the Brent oil price. So for a number of factors that I won't go into here now, that oil price is down about 35%. If you take that and say it persists going forward, that would mean that we take about a point off the level of inflation. So when you think that tariffs is probably adding between 1 and 2 percentage points, 1 percentage point will be offset by this decline in oil prices if they persist. So there's a silver lining a little bit to the downgrades to growth that we're seeing, is this decline in oil prices. In terms of what we can anticipate from the Fed, the market today is pricing around about 3 rate cuts by December of this year. And again, I find that a kind of a broad consensus of two extremes, that everything's going to be fine or everything's going to be very difficult. I'm not so certain it's going to be the actual outcome. And 3 rate cuts, when you're thinking about the hit of tariffs and people are talking about a recession, you might come to a conclusion that perhaps it should be a lot more. Well, I think we would be, we're in the camp of thinking maybe it's going to be a bit less than those 3 rate cuts, because I think the Fed is going to be hampered by a couple of things. One, of course, is that although growth is coming down, the mandate of the Fed is employment and inflation. It's not growth. It's how does that growth manifest itself in an inflation pressure, or whether people are being made redundant. So this is the biggest challenge that is often not talked about. And I think I mentioned this last time round, but I just want to emphasize this again, that we have had a very strict regime of immigration in the US since President Trump took office. And the likelihood is that this year there will be very little immigration. So if we get very little immigration into the country, the workforce will not increase. If the workforce does not increase, we are going to have a very tight labor market. So just to put some numbers on it, they're quite extraordinary, that the year-on-year increase or a number of people coming in through that southern border at the moment is down 95%. Morgan Stanley are now assuming that this year net immigration will be 1 million people instead of 2.7 million. And to give you some context of the growth of the workforce in the United States over the last 4 or 5 years, 80% of it has come from immigration. So if your workforce is not increasing in size, even though people have been made redundant, every year, 4 million people leave the workforce through retirement. So when you put all those numbers together, it's very difficult to see a significant spike in the rate of unemployment. And this is crucial because inflation is definitely going to be higher than where the Fed is mandated to bring it down to. I think most people would assume the Fed is targeting 2 to 2.25% inflation. But we're not going to see an unemployment rate that typically has to get above 6% at a rapid pace before the Fed, in a sense, is mandated or would be minded to cutting interest rates aggressively. So, as I said, for me, it's just not a done deal that we get significant rate cuts this year, given the immigration situation and given this spike in inflation that's almost certain from the tariff situation. So let's just think, what does that mean for financial markets? Well, the markets are kind of balancing between two views here. The orange line shows the high yield spread. And at one point, we were very concerned, or the market was very concerned in those early days of April about a recession. And therefore, there was a big spike in spreads. Indeed, they've risen from around 300 basis points to 450. And that would have signaled recession, but we've come back down from that number. And secondly, the blue line is the level of the 10-year bond yield, which today is around about 4.3%, 4.3. And then again, that indicates a split view between the trouble that we might get from recession, which means a disinflationary environment, and the trouble we get from tariffs. Now, my concern is not necessarily the next 3 or 4 months on the 10-year. It's a bit more longer dated, that over the next 12 months, I think we're going to have structural challenges with the level of 10-year yields. I think they're going to have to reflect more the reality that inflation is persisting higher than we thought. And secondly, that we're going to see, I think, problems in terms of long-term indebtedness. So just to quickly go through this, because I think I'm covering ground that we've covered before, but we have seen a very significant increase in indebtedness in the US over the years. We're up to about 100 to 120%. If we assume that Trump gets his way and puts back into place or extends the tax cuts that he's talked that have been there before, but just need to have an extension, then the debt to GDP of the US economy is heading towards 150% within the next 10, 15 years. And that, I think, drags bond yields higher. And the other important point is that although he may talk about cutting spending in certain elements of US government, the biggest challenge for the US indebtedness is this deficit, which has to include, of course, the interest bill. And that interest bill is going up. So if you put the interest payment, it actually is about 60% of this deficit that the US is struggling to bring down. And again, these independent forecasts, so that deficit is going nowhere. It's going to have a larger component of interest payments in the future. And therefore, you're going to be looking at a government that can't repay its debt and is going to be increasingly called to account for that. And therefore, that I think that means higher yields. So the other challenge, of course, is we have two contrasting characters here. I think there was the golden period of Alan Greenspan, great credibility. No president would ever challenge him. And yet we have Mr. Powell sitting here with obviously a huge challenge of a huge personality in President Trump. Now, why is this important? Well, it's important because the market may believe that the Fed is not going to be in control of monetary policy. And that will take us back to what I call the dark days pre-Greenspan, when there wasn't so much credibility. It was perhaps more politically motivated. It didn't have the same disciplines. And so what's the difference between those two things? It's around about 200 basis points on yields. So we would then be looking at a 10-year yield of 6% and not the 4 to 4.5% that we see today. So the 1990s through to the early 2000s was the golden period of bringing that, what I call a risk premium, down. We now have a number that's just been edging higher. And I think with the pressure on Jay Powell at the moment, this is something that could explode higher, not just because of his own credibility and what Trump may be doing, but also because of that indebtedness. Go back to those early days, debt to GDP ratios were around about 60% and falling, as opposed to 110% and rising. The other thing is that, and it's, again, this is more of a, not saying that the whole world is finished here. It's just saying that that era of US exceptionalism is over, whether it's the low risk premiums on US debt or it's the valuation of US equities. US equities today are on a historical P of 24 and a forward P multiple of 20. That P is expanded because the gap between price, which is the blue line, and corporate profits has widened very substantially. And I almost felt good at the time when we got that big correction, because it felt like the US market was getting back to fair value. Today, we think it could be as much as overvalued by 20%. Just again, I make the same point as I made last time. The dollar remains vulnerable. It's a kind of hidden vulnerability in a sense that I think there are institutions and individual decisions being taken around the world at the moment to downgrade the US, either in terms of the scale of the interaction between the corporate and the US economy in many different guises. But I'm also seeing it in portfolio management where people are saying, I need to take more of the US economy out of my portfolio. I don't want that risk. Bear in mind that we are only about 6% of the way into Donald Trump's period of office, and there's still a lot of decisions and noise to come. So how do I balance that position that I find myself in as a portfolio manager when I sit there with whether my private equity, which is 60 or 70% in the US, my equities, which are around about 70% in US, or my bond portfolio that's probably around 40 to 50% in the US. I might be minded, and I'm seeing flows that show that people are starting to move into other currencies and asset classes that have less US content. So the talking points, US recession, just to summarize, a 40% risk at the moment, but possibly rising, because I think we'll wait to see that hard data. But the soft data at the moment and those small data points do point to more trouble. Will President Trump back off? They say, well, he's into deal, he's negotiating, these things will come down. We still have not had one substantive deal done. So what can I say? Also, how much is going to change in the US? You know, whether it's the interpretation of laws, whether it's a constitutional crisis, these are things that we weren't talking about 6 months ago. So if we're talking about them now, something has changed. If something has changed, whatever we talk about in terms of the US, we are seeing more positives around the world. I think what the US is doing at the moment is actually forcing other countries to do things they should have done. Europe is spending more money and standing on its own 2 feet. Out in Asia, we're seeing countries that are now trying to accelerate these trading routes that you see in the slide. And we are seeing countries that, such as China, I think, sensing that they have to move on a more accelerated path of reshaping their economies to deal with the challenges they have. So if that brings about structural change in Eastern countries, I think you're going to see portfolio money and capital follow as well. So I'm positive about the future, but the future will be very different from the past. The past was about the dominance of the US. The future will be about the re-emergence stroke acceleration of the emergence of the East.
Very good, Gary. Very good. Very good. Thank you for that. I mean, you know, you said at the CDC conference, the guy said we all have to get COVID before it's over. Sounds like we all have to get Trumped before it's over. Francis, if I can bring you in, you just, you know, so you're all about enhancing the performance for private equity funds and family offices that have real life businesses. So their whole world's going to change. I mean, what do you think from the ground up at the moment?
Yeah, I mean, from my perspective, there's I don't know, signs of light and signs of distress. Obviously, that it's a dramatic shift in the entire elite of the United States and what they're trying to do, and I think people are trying to catch up to this move fast and break things administration. Trump learned how to deal with the bureaucracy and has surrounded himself with people who are supporting him rather than trying to hold him back. There are a lot of people in the first administration who tried to sort of be the adults in the room and, you know, use the bureaucracy to slow him down. And I think he's trying to, you know, do something Reagan-esque or Thatcher-esque in that sense, but it remains to be seen. I mean, you can look at this as half full, half empty. But if deregulation continues to stimulate growth, then we can grow our way out of so many of these different problems. It's just a question of you know, how much gets implemented in terms of these regulatory changes. And you know, my conversation today is going to focus a little bit more on the China-U.S. relationship and what you know, what we see coming. Did you want me to go into the presentation, or did you want to do some questioning?
Well, why don't we just go through the presentation? I got some questions up that. I mean, I think just for context, you know, a lot of your clients, you know, you're an American who lives in Shanghai for a long time, and
yeah,
you know, you've seen the transition from the U.S. multinationals asking you to transition with supply chains, and now you've got private equity funds and family offices going both sides, east and west. So maybe you could take us through with your presentation just what you're seeing, the immediate pain points and touch points and changes and opportunities.
Yeah, and a lot of what informs my opinion is based upon the work that we do for mostly the middle market private equity world and the family offices out of the U.S. and Europe. What I'd like to do is sort of set the stage on what I think is happening with the trade relationship, and then what are the implications, particularly for supply chains, but also demand. I think is also very interesting to take a closer look at. So with that, let me get into this. When people look at sort of the trade discussion, there are all these very sort of funny and sometimes I think quite silly images and memes out there that the U.S. is just shooting itself in the foot, and it's a headless chicken walking around. So this is like Trump's new flag, right? The United States of headless chicken. And you always hear people say the U.S. is unpredictable and doesn't have a plan. And I think if you look at this somewhat dispassionately, you can go back to these few ideas that have been driving Trump for a very, very long time. We had some interaction with him in the 90s in doing real estate deals in China. And he had a very sort of, I think, rational approach to the market and was wide-eyed. His eyes were wide open. And I think if you look at him, there's this side of Trump, which is, like the Worldwide Wrestling Federation, and it's a circus. And then there's this other side, which is quite structured. And I think he's structured around the Phase 1 trade agreement, which was signed in January 2020. He had discussions about the Phase 2 trade agreement with China, which went absolutely nowhere. He's often talked about WTO, trade balance, and national security. So I think these are sort of his guiding lights. And right now, the big issue with China is that we signed this Phase 1 trade agreement. A lot of it hasn't been implemented. And that represents about 40% of what the United States actually wants. And the other 60% are things that China really is never going to agree to. So, for example, trade in services, tech services, financial services. When is Goldman Sachs private wealth management going to be allowed in China, free and open? When would the capital market might be open for U.S. product? When would tech services like YouTube, LinkedIn, you name the web service that's not available in China, even Shopify is difficult here. So I think these are the things that are almost unresolvable. So these are sort of the fundamentals. So if you take a look at sort of the main focus on the right-hand side there, the U.S. is trying to do these things, and many of them are unachievable. So then the question is, we have this chicken and the duck talking to one another, right? China wants one thing and the U.S. wants another thing, and so we don't really know how this can be resolved. And I, in some ways, I'm quite pessimistic about the future of the U.S.-China relationship, because I see very little, sort of talking points. And you can see we're sort of 6 months into the U.S. administration, and we've had almost no high-level dialogue. We've just had it's like watching two children in a playground punch each other in the face. It's elevated to about that level, or descended to about that level. So, the impact on the supply chains has been very, very dramatic. I mean, every project that we work on right now, we describe as anywhere but China. So people come to us and say, I need to get out of China, and so where do I go? So it's quite dramatic. And I think that what we saw happen in the furniture industry 5 to 10 years ago is instructive of what I think is going to happen now. So today, if you buy a sofa in Vietnam, this is a leather sofa sold in the United States, you buy a lot from China. Basically 40 to 70% of the total value add is sourced through China. And in particular, some of the bigger things like this metal mechanism on the right-hand side for your motorized couch. But even if you pull apart the whole couch, you'll find that the leathers are basically tanned in China. A lot of the wood is cut in China. All the sort of mechanisms running around the inside of this thing are coming from China, the springs, sometimes even the foam. But it's interesting what's happened over time. So if we go back and look at 2018 to 2020 time period, basically China goes from 170 million of of exports to the United States to 2.7 billion. And over that same time period, Vietnam goes from 32 million to 1.8 billion. And if you sort of follow this going forward to what's happening today, it's now to the point. So this is 2023 numbers, the latest numbers from the World Trade Organization. Vietnam's the leader. It's almost 3 billion. China's declined a bit in sort of percentage wise. China is still, interestingly, the volume leader. So it's got 28 million units, whereas Vietnam's about 22 million units. And then the average value is still cheaper in China. And then also what you see is something that we see across the board is that over time, people figure Mexico out. And Mexico, which wasn't even on the radar 5 years ago, has now become probably the dark horse in the race, which will overtake China, I assume, sometime over the next 5 years. And so for most supply chains that are focusing on China, and this is particularly, most supply chains that are supporting European and North American markets, this is kind of what the future tends to look like. There are some pockets where China is irreplaceable. Electronics is one you see these days, and small parts, and a lot of areas in the low volume, high mix space, China continues to be extremely important. But over time, I think the supply chains will get built out in Mexico, and China will be of decreasing importance in many of these markets, particularly if the tariffs stay at the levels they are right now. I mean, it's virtually impossible to ship a couch from the United States to China. I'm sorry, from China to the United States and still be competitive at 154%. Like they could figure out 20%, 30%, 40%. You could still figure that out, but at these levels, it's virtually impossible. So that's kind of the short part of this. There's one other aspect that I thought would be interesting is the China market from a demand perspective is also still quite fascinating, I think. A lot of people are not, focused enough on what the wealth that has been created over the last 20 or 30 years. We basically have 400 million people in this economy that consume at middle to high income levels on a global scale. So if you take a look at what happened to Lululemon over the last, since 2017, they came in here, opened 3 stores in 2017, and today they have I think about 200 stores and $1 billion in revenue. And there's just no other place in the world that you can do that. So there's this kind of tale of two worlds here, in that this, from a supply chain perspective and from a macroeconomic perspective, things that Gary was talking about seem to be a global pandemic of debt, demographics, and basically lack of leadership as well. There seems to be a global pandemic of these problems.
But Francis, if I ask you a question, you knowing some of your clients, some of the larger mid-market private equity funds, and then some of the families that have emerged and taken advantage of this offshoring out of Mexico and South America. How are they fixed for this new world order going forward? What changes are they making that you're seeing? Like how does the furniture company, does it relocate to Vietnam? How are they doing all this? Because the private equity funds put a fair bit of money in there and need to get a return in 2 to 3 years. What are you seeing happening?
Well, this is the interesting thing about private equity right now is that, and I think truly the opportunity for the family office or what I'm calling patient capital. The private equity funds, because they're on those 5 to 7 year cycles, they're trying to come up with new things, continuation funds, because the market really is not ready for any type of sale, trade sale, strategic sale. Public equity markets are generally closed to these types of transactions, and so I think that the smart private equity funds are looking at these opportunities and saying, okay, we've got another 5 to 10 years to deal with this asset, but yet it's a very strong asset. And so I think that there are a lot of brands that are differentiated products that have access, let's say, to the US or European markets or opportunities in Asia to grow that are hamstrung because of the dynamics of private equity. So if the private equity firms can't refinance the debt or somehow keep hold of the company, a lot of people are trying to go into sort of a Buffett long-term holder of asset type of structure, and to move away from a forced sale every 5 to 7 years.
Yeah, I mean, Gary, if I can just talk to you about that. I mean, we were talking last night. I mean, we're seeing LPs in the private credit market selling, getting out now. You're on mute, Gary, just so you know. I mean, we're seeing a lot of private credit LPs getting out now. And then we're seeing a lot of PE LPs just not fulfilling their commitments to funds. Then we're seeing businesses struggling with the New World Order. So we got depressed businesses out there without cash flow. So, and then you're saying that, as businesses grow, as businesses go broke, we won't get growth. We won't get our 3% cut. Mm-hmm. You're in the UAE. What are you seeing the families doing out there? Are they looking for regional deals? I mean, I know one deal that we're working on together, the families with regional. What kind of trends are you seeing out there?
Yeah, I think there's two aspects. One is, I mean, there's been this love affair with the UAE or the GCC in general with the Americas, right? So they would buy a building, they'd buy an office block, they'd invest in businesses. A lot of the private equity deals were very, very focused on the United States. That had changed. But then again, I'm seeing this as an accelerator of that change. So if they were walking around other parts of the world looking for the deals, they've got more people doing that. But the other thing that you've seen in the newspapers and you've seen through the leadership here over the last 2 or 3 months as all this has happened is, we're going to do a deal to bring manufacturing here in the UAE. Now, the UAE can't be a Mexico, but it's kind of just geographically a good halfway house with cheap energy and an ability to bring in labor very, very quickly and apply it. But clearly it needs an investment. So it's interesting that the domestic investor here is also thinking about bringing those manufacturing franchises into the Middle East to serve a global market. So those are the two things. I would just say one thing on the secondaries. I'm sitting there thinking, this is going to be a real mess. But I was sitting with a very big client yesterday in Asia, and they were, we were talking about the launch of one big brand name private debt fund that's going to mop up all this secondary business to make some big profits. But I think liquidity comes in very quickly. I think people see the opportunity by the mess that we have at the moment, and that will be to buy things at big discounts. So if you're holding a fund today, you're going to have a liquidity event, but it's going to be pretty nasty in terms of mark to market. But for those kind of funds that are sitting out there waiting to do the deals, that money's going to come in quickly.
Yeah, I mean, mark to market. I mean, but then I come back to, the people on these calls are investors, and we have families here that have real businesses that are changing. I mean, Regina, if I can just come to you, like families that we're dealing with here in Asia, what are you seeing how they're responding to this? I know you've had a lot of conversations recently.
Yeah. So, many families have a lot of family businesses. Asia is typically family business owned. And the supply chain issue that, Francis has mentioned, people have been grappling with this since COVID, right? So there's been a lot of connections being made within Asia to try and move this reliance from the US. But for the private portfolio, where we have conversations, what we're looking for is obviously pockets of opportunity and also long-term wealth legacy planning. So there are many families that have been more actively looking at their wealth statement, their legacy, and that's where we work with Gary, GCIO, in terms of planning and providing that portfolio resilience into looking where it really matters for the clients, how we can invest in a strategic manner, alignment of the portfolio with the family's wealth and the risk tolerance, and obviously, the changing generations goals of today, right?
Yeah, I mean,
So
I see, I mean, just like, I mean, I see that with some of the clients that we have where they actually have first or second generation business in Indonesia, and now are in Thailand, and now they're actively partnering with their peers who are second generation out of China and saying, okay, we're a large Chinese company, how do we pull it together? Okay, guys, this kind of brings us towards the Q&A side. We've got a couple of questions. I guess, Gary, we've got one for you, which is, given the vulnerabilities of the US dollar and the US balance sheet, what is your viewpoint on specific geography and currency allocation in an optimum portfolio? Sounds like a cheat in the exam.
Well, I'm just going to say
Yeah.
it's just less dollars, I suppose, in the future. Of course, when people look at everything else, they go, "Well, look, does the Europe look that good?" But I just think it's kind of it's always a relative game in currencies, and it's very easy just to have a negative about sterling, euros, and yen, and say there's no opportunity. But the problem, I think, in terms of making significant currency moves in your portfolio, is just the lack of liquidity. So if you look at the Singapore dollar and Swiss franc, there have been tremendous stores of value over the last 10 to 15 years. But in either currency, if you go and try and buy a bond, you're not going to find very many financial instruments in those currencies to get that kind of diversification. So to be honest, it's going to play to the new game, right? So it's going to be more Bitcoin or that kind of style of investment. It's certainly
Yeah, I think Gary's been frozen out.
wide.
Gary,
Will
what
be.
about this Saudi yuan digital gold currency?
Well, as I said, I think it's about getting more and more liquidity. So it's getting an acceptance of whatever that concept is, right? So there's many, many of these different forms being created, but it's about getting liquidity of them, getting an acceptance of them, getting a unit of account that's being used in many, many forums. And I think that will happen. If there's one thing, we've obviously got a lot of people from across the world. If there's one thing that's really got people angry, is since the Ukraine situation, which we can all have a view on, but the way in which the dollar was weaponized, that still doesn't go down very well here. And even for a country such as the UAE that has a peg to the dollar, I think in times that will evolve into something like what Kuwait has, which is a basket of currencies. Now, Kuwait has only got a fractional allocation to other currencies. But you could see these pegs evolve into something that's not just into the dollar, it's into other things as well. And that could, quite frankly, even include some of the digital currencies.
Okay, that was a question we have up there too about what does it mean for Hong Kong's peg. So I think you've answered that. But there's another question up here. It says, will it change the dominance of the US stock market? Will the New World Order change the dominance of the US stock market?
Well, I think, I think of the dominance of the US in stock market indices, we're finding that institutional investors, some have done it and some are talking about it, which is to cap the allocation to the US. So at the moment, most people follow an MSCI World, which gives you something between 65 and 72% allocation via the benchmark into the US, and people are going to cap it at 50%. So I want a bespoke benchmark. I think I'm taking too much risk. Therefore, please, provide me with something different. So that's what I think we'll see. We'll find more bespoke benchmark.
Okay, we lose them again. Francis, I have a question. I have a question for you. I've got a couple of families that I know that are Asian-based families with operations now in Dominican Republic, Mexico, Latin America. I mean, how do you feel those countries are going to fare? I mean, so a lot of those were set up to get around the renegotiated NAFTA. How do you think those, and they're frankly, they're Chinese companies in joint ventures with local families. How are those companies going to fare moving forward? Are they going to be seen as Chinese? Are they going to be seen as Mexicans, Guatemala? What are they going to be seen as?
Yeah, it's funny. We talk to our clients, the American ones who come to China and the Chinese ones who go to the United States, and we say that you want a veil of plausible deniability about your country of origin. That it's your persona non grata in the United States if you're Chinese right now. It's to a ridiculous extent. I mean, this sense of China sentiment is absolutely ridiculous and real. And it does extend to their investments in Mexico or anywhere else. And so, again, I think this is the opportunities for, let's say, the Mexican families or the Spanish families that have assets in Mexico, and the Indonesians and the Hong Kong Chinese, even at that point, I think have at least a greater level of plausible deniability, although maybe the Panama Canal incident might be a counter to that argument. I think there are creative things to do. We were talking about something with a client yesterday about taking a Brazilian production facility for the automotive aftermarket, and rather than adding capacity, so this is a Chinese company that needs to move out of China because of the tariffs, but rather than adding capacity, that they move to, they basically go to the Brazilian partner. They create a Brazilian partner and say, we'll build the product for the Brazilian market. You build the product for our client in North America. And then therefore it's exported to the United States as a Brazilian company. And I think those are the types of transactions that I would be looking at. How do you create some type of partnership with many of these second or third generation Chinese companies that, frankly, they're not as qualified as their parents were to really, be the entrepreneurs that currently hold the reins of these companies. And so they need, and they're also maybe even tasked with something much, much more difficult. Being Chinese and setting up an operation in central Mexico and dealing with the cartels is not something that's for the faint-hearted. Yeah. So I think that the same thing I would do in Morocco right now is very, very hot. Eastern Europe, Poland, all these markets I think are ripe for creative partnerships, ideally with some type of put and call option on it, so that you can help build the company and have a structure to make sure everyone's fairly compensated for what they bring to the table.
Okay, guys, well, just looking, I think that's bringing us to a nice end. Thank you guys for your participation. I think just in closing, it sounds like Liberation Day has freed up the rest of the world to take on its own independence, which sounds to me like a healthy initiative for all of us. Thank you very much. We will hope to see you on the June call, and thank you very much, guys. Take care.
Good day.